Good morning. Welcome to the lecture notes for chapter 4. In this chapter, we're going to talk a little bit about the balance sheet and the statement of cash flows. Okay, I'm on slide number 2. So we know, and if we remember from accounting, the balance sheet represents business assets and liabilities. Okay, whereas the statement of cash flows basically uses information from the income statement and the balance sheet, and basically it pretty much tells a facility or business where their cash is going. Okay, so it has a way of revealing how that cash is being obtained, and in addition to that, what that cash is actually being used for. Okay, on slide number 3, there are 3 main components of the balance sheet. You have your assets, your liabilities, and your equity. Now, the balance sheet, what makes it different from the income statement is that the income statement pretty much reports the results of operations over a period of time. That's the way the income statement works. Whereas the balance statement pretty much represents your financial position at a given point in time. Okay, I'm gonna say that again. The income statement, how it differs from the balance sheet. The income statement basically tells you how you operate in your finances over a period of time, whereas the balance sheet gives you your position financially at a specific time, so at a given point of time. In slide number, I told you at the end of slide number 5 that the most prominent characteristic that you have to remember about the balance sheet is that it must balance. So your left side should equal to your right side. Okay. Now, in slide number 7, I just gave you it was just a quick overview of what assets look like for Sunnyvale Clinic. And I pretty much gave it to you where it's broken down into cash that they have divvied out, short-term investments that they've made, some long-term investments, and over between 2014 and 2015 what their total assets were. So of course you can see there was an increase in their total assets between. Those are things such as like cash or cash equivalents. They may even be some things such as short-term investments. So a lot of time when you make short-term investments, you just kind of invest in making an investment for a short period of time. So a current asset is usually an asset that is expected to be converted into cash usually within a year. Okay, so your current asset is something that you intend to make an investment on within a year. It'll turn into cash for you to make that investment. Okay, cash, pretty much anything that's actually in hand, or it may be just a regular commercial checking account. Okay, short-term investments, slide number 9, pretty much those are usually investments that have a maturation date of less than a year, but greater than 3 months. So pretty much these are things that you're going to pay out within a year period of time. For most places, for most things rather, it usually is going to be, it may take you more than 3 months. It's just like when you get a loan, so to speak. You get a loan, you get a short term, you may get a loan for like $1,500 or whatever. But your goal is to pay that loan off within 6 months or even within a year. You're just making a short-term investment. You're just taking $1,500, you're investing it in something, but you know within a year's time it's going to be paid off. Okay, so why do businesses hold short-term investments? Still on slide number 9. Organizations hold cash equivalents and short-term investments because cash earns no interest and money held in commercial checking account earns very little interest. So that's why a lot of businesses, when they have short-term investment, it's because they know cash will that cash will earn no interest because you're spending that. Also, anytime you have money in a commercial checking account, yes, it may collect interest, but it's going to collect very little. Okay. Because your current assets, on slide number 10, because assets can be converted to cash in a quick manner, for organizations, that's classified as liquidity. Okay, because it's a short-term investment. It won't take long before that investment is paid out. So we call that liquidity. That also has to be reported. Inventories, on slide number 12, inventories is actually the dollar amount that you spend on supplies on hand. Okay, you have to do inventory. Inventory is part of cost for your facility, and you have to include that when you're doing your financial budgeting, when you're doing your balance sheet, because that's a part of an expense for your particular facility. Okay, so long-term investments. These are usually things, this is where you making pretty much a asset that's going to be greater than a year. Okay, so that's more or less like something that may take you 15, 30, 25 years to pay. Those are called long-term investments. Okay, so we look at slide number 15, property and equipment. That too is a part of an asset as it relates to your business. That can include anything such as the land that you're leasing, or perhaps the land that you own, so to speak, any buildings that you're using, and any equipment that has to be used. We call that net property and equipment. Again, that has to be mentioned on your financial report. And if you remember from previous classes, those type of assets, property and equipment, land, buildings, and things of that nature, those are usually fixed assets. Why are they fixed? Because they won't change over a period of time. Now, if they were a variable cost, such as supplies or salaries, and pretty much we're talking about, and when we're talking about salaries, we're talking about like your hourly paid personnel, that then it will be considered a variable cost. But in this case, your land, buildings, equipment, things that are not going to change, pretty much consistent every month, those are classified as a fixed asset. Okay, so let's look at slide 18, liabilities. Liabilities are pretty much any kind of claim against your facility. Any kind of claim. When you fail to meet your liabilities, this is how bankruptcy and potential closures occur for your facility. So you have to understand that liabilities are obligations that have to be paid, whether it's going to employees, to tax authorities, vendors. But your largest obligations are the ones to the creditors. And these are the individuals that help furnish the debt capital to the business. So when you're borrowing money from loan companies, or let's say, for instance, when you're borrowing from creditors, you have to understand that that money has to be paid back. A lot of times what get a lot of businesses in trouble is when they borrow so much, but then they're not producing the capital to be able to afford the ability to pay back that loan that they've gotten against the business. So anytime you do that, you've taken a claim out against that business. Have what you call current liabilities. Those are the ones that have to be paid within a year. Current liabilities have to be paid within a year. And the most common types are your things such as your notes payable, your accounts payable. So let's look at each one of those. Slide number 20. Notes payables are your short-term obligations. Basically, these are like your bank loans. They usually have a maturation date of a year or less than a year. And so they're usually in the form of what we call line of credit. Okay, so that should sound familiar to you. If you've ever taken a loan before, you know how you have a line of credit. So that's pretty much, these are called like your notes payable. Your accounts payable are usually goods that you have bought from vendors, and we call them, it's kind of like on trade credit. Basically, this is where you have like payment terms of like 30 days. It's like you have 30 days to pay an invoice. So it's like you purchase something from a vendor. So let's say, for an example, you purchased butterfly needles from one of your vendors, and they invoiced you for those needles. Okay, that's a supply to your facility, but that's considered as accounts payable, because guess what? Within 30 days, that invoice needs to be paid. So because what makes it accounts payable is the fact that you have purchased it, but you have not yet paid for it. And that's the way it works in most businesses. You will order things from your vendors, and that you're going to do that all the time. And when you order from your vendor, they're going to send you the good that you have bought from them, but you won't get a bill from them until within 30 days. So it's like you have 30 days to pay that particular invoice. Accrued expenses are your payment obligations to the business. So some examples: salaries to your employees. Okay, so you pay these are the salaries that you pay to your employees for their work that they're doing. Taxes that you have to pay to government authorities, and then any kind of interest payments that you have to pay. Long-term debt, that represents, slide number 23, represents any kind of debt that you have that's for more than a year. We call that long-term. Any kind of debt that you have from either a loan, a bank, anything like that, we call those long-term debts. And that's because you're going to be paying them for more than a period of a year. Equity, of course, represents any claim against the business. Okay, we call those net assets. And the way that you, again, calculate your equity, how do you calculate equity? It is total assets minus your total liabilities. Okay, so let's go down to slide number 28. Now, the right side of the balance sheet is the side that pretty much has a mixed section included with it. So basically, we usually look at the right side of the balance sheet. We call it the capital structure, because that pretty much lets you know what kind of risk you may be at, and then too, your cost of financing. Okay, so we call the right side of the balance sheet, we look at it as like your capital structure. Okay, slide number 31, it goes back to talk about statement of cash flows, and pretty much we know the statement of cash flows. As you remember, when I first started talking in the beginning, it gives you the results of your financial status over a period of time. Okay, so basically the statement of cash flow serves three purposes of answering questions. Where do you get the cash? Where does the business get the cash? What does it do with the cash that it has? And how does it change position? How did its cash position change? Is this valuable information? Yes, because you need to make sure that for every dollar that is spent out, you can account for it. You have to make sure that you don't wait until the end of a fiscal year and you're trying to figure out, where did you spend $500, $1,000, $1,500? Where did it go? You need to be able to answer those questions all along and not wait until the end of a fiscal year to try to figure all of that out. Now, the statement of cash flows is pretty much divided into three sections. You have cash flows that's from operating, investing, and financing activities. I'm on slide number 32. Okay. On slide number 33, I put you an example of a cash flow statement so that's like the top portion of that. The middle section lets you know where you've put most of your assets. It also talks about your non-operating income. Okay, remember that from previous chapters. And the bottom section, of course, tells you about any short-term or long-term financing or debt that the facility currently has. When all sections, let's say this. The most important section on the statement of cash flows, the most important section, the very bottom of the statement of cash flows should reconcile with the balance sheet. So these two forms, or these two forms should coincide with each other. Okay? Because remember, you're looking at your statement, your cash flow statement, to tell me about, or to tell you rather, about how your finances are operating over the period of time. Whereas with your balance sheet, you're looking at things from, or you're looking at your financial things from a specific amount of time. Okay, does that make sense? Okay. Then what you have going out. So that's something that you need to keep in mind when you're looking at ratio analysis. Okay? Now, this pretty much concludes the notes for chapter 3. The notes for chapter 4. So just make sure that you still go through chapter 4 and review and read through the chapters once more so that you can get a much better, clearer understanding of the concepts. If you have any questions, any issues with anything that I can make a little bit more clear to you, please make sure that you reach out to me. Again, the PowerPoint slides are located in DocSharing, and you will also have access to this audio lecture as well. Thank you.